Hello guys and welcome to a video presentation on intraday market profiles. So today we're going to talk about, or we're going to discuss intraday market profiles for London, and there are essentially two main market profiles for London. We have the intraday sell profile. Now what I want you to do for each of these examples is we're going to discuss for the sell side or for bearishness, and for the buy side you just simply invert the concept and you get the same thing for the buys. So this profile actually should be more of a intraday sell and buy profile, but again we're going to run through, for example, or just for educational purposes, we're just going to run through examples with bearish profile for the concept, and then we're going to look at bullish profile for the actual price action example, so you can see how they translate in both the bearish condition and then also on the bullish condition. So we have two main profiles for London session. We have the London normal protraction and we have the London delayed protraction. Now with the normal London protraction, we have our classic jitter swing. All right, so jitter swing essentially is the false move from the session open, which is what sucks in retail to chase price the opposing direction to daily sentiment or daily buys, and then the market creates the high of the day once it runs up into level of premium and then reverses and then runs lower or starts the profit release phase going into London close. This is the classic London normal protraction. Now the classic delivery for this style, and this is what you're going to get majority of the time or most of the time in terms of looking for a setup. The basic delivery mechanism for this is that usually you get a central bank dealers range. You will oftentimes have the CBDR create a very nice and tight range, or the Asian range usually will do the same thing. So you're either going to get the central bank dealers range or the flout, and the market will then going into London session start the false move. Okay, and this is where you get your classic manipulation play at London Open, and as you see that nice little consolidation at the central bank dealers range, and also oftentimes it bleeds into Asian session, then you already know that we are seeing a squeeze, and the sudden run out of that consolidation is what retail chases. Okay, and what we want to see is that run for our high time frame premium. We can see here, usually the run or the false move from the session open is going to be a run into an high time frame premium, oftentimes plus a standard deviation. Now what I've taught you for a bearish profile, you're looking for a 1 to 2 classic standard deviation for the high of the day. Classically it's 1 standard deviation, right? But we can allow for as far as 2 standard deviation for a high of the day for a London session. Okay, so around the first 2 hours of London, we're looking for that aggressive run against our intended direction to either 1 standard deviation or 2 standard deviation of our central bank dealers range or the flout, which we can then blend with a premium array. It could be a 1 hour bearish order block, it could be a 4 hour bearish order block, or it could be a data level. And usually if it's an high time frame level, you get really explosive delivery from there, because again, remember, high time frame level is usually where the algo will draw price into to allow for interbank dealings or interbank price delivery. So when the market or when the algo draws price into these higher time frame levels, then the central bank just then step in and provide liquidity to the funds or institutions, and you see large sponsorships or large deliveries away from that level. So if it's an higher time frame level, then you're gonna get really explosive move or moves in the direction of order flow. So we like to see the central bank dealers range be a very small little range. Preferably we don't want to see any kind of trendiness, aka we don't want to see the market create higher highs or higher lows, or lower highs and lower lows. We want to see the market stay in a nice consolidation. So we want to see the profile for central bank dealers range and Asia, or central bank dealers range or Asia be a consolidation profile heading into London session. So we don't want to see the market start a real delivery ahead of London, because what we're expecting is during London session, the market is going to make a sudden run that then induces liquidity against order flow, and then that sets the stage for the delivery the entire day. Okay, so here we get a classic delivery profile where the market goes in, again, just to rehash what we've talked about, the market goes in a very tight consolidation. Usually we want to see less than 40 pips, we like to sit around 10-20 pips is ideal, depending on the pair we're trading, right? And heading into London session, you want to see that false run out of Asia's range, which is the jitter swing for London session, and then that sucks in retail to go into one side of the marketplace, and that sets liquidity for the opposing side of the marketplace. Now, what's also important to note that if you miss the initial run, or if you miss the initial chance to sell short, because that's usually scary to do, especially if you're new to doing this, right? When you see the market started running aggressively against your intended direction, that can be scary to go in and short. And the mindset I've trained you to view the market in is that when it is scary to execute on the trade is when you should actually be executing on the trade. Now, you can use your standard, or you can use a standard 30 pip stop loss for a London session. This is the model I used to trade way back. I think that was 2018 going to 2019, when I used to trade London session more often than New York session. When I was taking positions on, especially on the majors, I would use a 30 pip stop loss, right? Because if the average daily range for a pair is 100 pips, which is then for euro, I think it's up to 100 pips now. For pound, it is more 100 pips, but for the other majors, it's not. Probably US CAD or so, right? But again, if we are assuming that the average daily range or the average pip count for a pair is 100 pips, then by using a 30 pip stop loss from that initial manipulation during London session, if the market goes and stops us out, then most likely we're wrong. Because if we see an initial run of like 20-30 pips out of Asia's range, then the market is almost getting up into its ADR high. If our daily bias is correct, then we should not get stopped out if we are shorting above Asia's high during London session, the initial manipulation. Okay, so what that means is going to use a chart, for example, like this. All right, so let's just squint all of this. So if our ADR, or if our average daily range is 100 pips, for example, a lot of major currencies, their average daily range is not even up to 100 pips, okay? But if we're assuming that the average daily range is 100 pips, okay, so from the high of the candle to the low of the daily candle is 100 pips. Usually during the Asian session, the market would still be relatively around the open price, and then during London session, it will start to run higher. Like usually will run around 10-20 pips above Asia's range. Now, if we're shorting here, okay, with the assumption that our daily order flow is bearish, right? We want to use 30 pips above where we're shorting above Asia's range, because it's very unlikely that the market is going to run another 100 pips if it's going to be bearish, okay? Because it still needs a lot of time for expansion on the downside in line with higher time frame order flow. So typically especially if you want to, again, we're not talking about the models yet, but we're going to talk about models for trading London session. But a classic stop placement is going to be 30 pips, because that is around 1/3 of the ADR for a pair, right? So the likelihood that you're going to get sucked out with 1/3 of the average daily range of a pair against its intended direction is very, very low. All right, and I think another main problem for a lot of you guys is that you're going in trading London session and you want to use that 8 pip stop loss or 10 pip stop loss. I never do that for London session. Okay, I can go in and do that for New York session, or even London close. All right, for London close, a lot of times I'll use about 4 or 5 pip stops, or 6 pip stops at most, or 8 pips. I think sometimes I use 8 pips. For New York session, usually it's an average of 8 to 12 pips I use for New York session, right? 8 to 12 pips is the average stops I use for New York session. But if I trade London session, my stops are usually wider, to more like 20 pips to around 25 pips stops for London session. And the reason why I do that is because London usually has more, the manipulation play during London is more extreme than that of New York, because New York usually is a continuation from London's price delivery. Right, and the mistake a lot of you guys make is that you're going into London session and then you're using tighter stops. You're using like 8 to 10 pip stops for London session, and that's not the way the market operates. Because your London session, the market is creating the initial high for the day in a bearish template, okay, and the market is going to try its possible best to, as much as possible, offset any early shorters in price, okay, and that would happen by a lot of times you see the market make the initial run out of Asia's range, make a short-term high, and then you go in thinking the market is doing that short-term high, and then the market runs even higher one more time, and then you get scared and you chicken out of the move, or you close out the move too early, or you get stopped out because your stops are too tight. Then the market starts the delivery cycle for London session going into New York session. So you always want to be cautious of your stop placement during London session, especially. Okay, now the classic London normal protraction is that London makes the high of the day for an intraday sell profile, and then going into New York session, we see a retracement into a premium inside the range formed during London session. This is classic profile, and then New York continues the delivery cycle, going to the end of New York, and then going to London closes where we start to see the market distribute the sells against existing sell side liquidity. Essentially, this is where the institutions will close up shop for the day, and then go into New York close is where the market goes into consolidation. So for a classic normal London protraction, you get the eye of the day forming around London session with your classic jitter swing out of Asia, which will match up with some kind of lower time frame premium or higher time frame premium coupled with a standard deviation. And then New York continues the profile, which is usually an ultimate trade entry retracement into the range formed during London session, and then London close creates the opposed end of the daily range, and then the market goes into a consolidation. Now, this same concept, you just flip it over for a bullish profile. I'm going to show you the examples with using bullish swings, but it's the same logic that goes into bullish profile. And then for the delayed protraction for London session, usually in this scenario, you don't get the classic jitter swing out of Asian session, okay? And this can be weird because a lot of times it throws up a lot of not retail, but it throws up a lot of institutional students or traders. And this is what I'm going to say. If you don't like this kind of model, no one's forcing you to trade model, okay? Usually, if because I don't like this kind of model, I would usually just wait until New York session. I can trade the model and still make money. But again, I don't like this model because I like to see the manipulation play, right? That creates more of a narrative, or that helps me gain confidence with my narrative. But again, if I'm anticipating the model and I do not want to be a part of the delivery cycle, then I'll wait until New York session to trade the profile. Now with this model, you're not getting a standard deviation higher for your delivery with a sell profile. There's no standard deviation. There's going to be a standard deviation lower to cap up the low of the day, but the eye of the day usually will form around sometime during the Asian session, and there's no real pronounced jitter swing from London. Instead, London is a retracement back into the range for Asian session that then continues the delivery cycle lower. Now, there are very special scenarios to expect this kind of profile, and those scenarios are when the previous day's New York session or London close makes a short-term high or low on the daily, and the next day needs to continue the delivery. So essentially what that means is during the previous day New York, so let's assume this day we're trading is a Tuesday. So that means during the previous day, Monday's New York session or London close session, the market made a short-term high or a short-term low, and there was not enough time to deliver that liquidity on the previous day. So what would the market will do is the market will carry over. So this is what I call, this is my own term, by the way. I call it carry over delivery. So the market will carry over delivery into the next available session, which is going to be London session. So during the Asian session, again, the market usually might see a consolidation. Sometimes, or a lot of times, you see Asia actually trend. So Asia would trend lower and then go into London session. The real volatility kicks in, and then the market starts the expansion. Then the market will start the expansion, and you're not going to see the classic Asian consolidation, which you would come to expect for a classic liver profile. And in situations like this, you can either wait until New York session to catch a continuation play, or you can gain confidence in trading that retracement play during London session by looking for SMT. Okay? In this example, essentially the protraction is delayed. All right, you do not get your classic normal protraction where the market expands out of Asian's consolidation profile, because a lot of times Asia is not even a consolidation, and this is how you can spot delayed protraction early. One of the ways you can spot a delayed protraction early profile is when you see a lack of consolidation profile with Asia. So when you see this kind of consolidation, lack of consolidation profile during Asia, and you identify the previous day made a short-term high or low in direction of order flow, then you can anticipate that the market will want to quickly expand and seek the next opposing liquidity. And this would create, as we head into London session, there's no need for a manipulation play, as market has already done that manipulation the previous day, so the market needs to start the expansion cycle. Okay, so what you're looking for in this example is you're not looking for necessarily a higher time frame PDR rate. You're more instead looking for a lower time frame, like a 15-minute or 5-minute premium for the sell profile. Obviously, for the bullish profile, you just flip that over or you invert that for the bullish profile, and you look for that kind of delivery. Okay, now the main thing I want to talk about is oftentimes with the delayed protraction, the low of the day or the opposing end of the daily range will form during New York session rather than London close. So usually around mid New York session, that's where you see the market from the opposing end of the daily range. Now this might seem like a throwaway comment from me or a throwaway line from me, but this is really important, okay? Because a lot of times what a lot of you guys will do is you go into the marketplace and you keep on trying to catch continuation profiles during New York session. If you want to catch continuation profiles during New York session, you have to do it early. Okay, don't expect the manipulation at the early portion of New York. So classically for this kind of profile, 7 to 8 a.m. Eastern is where you're looking for that expansion. Because from 8 a.m. or usually from 8:30 a.m. going into 10 a.m., that's where you see the market create the actual opposing end of the daily range heading into London close, and then London close would then retrace back into the overall daily range between London usually and that low that formed during New York session. So this is really key and important for the delayed protraction. And we're gonna go through price action to see the concept we're talking about. So we're gonna first do for the normal protraction for London session. Right. So how does normal protraction for London session, how does that look like? All right, so you can see this is price action from Friday, from 2 weeks ago. This is 16th of June. And if I just use a replay tool here and zoom out to a daily time frame. All right, so you can see where we're trading at on the larger time frame. This is a Friday, this is a Thursday, this is a Wednesday, this is a Tuesday, this is a Monday. All right, so you can see that Monday high of the week, right? This is your valuation by speculation. You can see we have 3 days of solid expansion. 1, 2. Look at the body, the size of the candlestick bodies. Large bodies, large bodies, large bodies. What are we reaching for? We're reaching for a discount array. What's that discount array? It's going to be a short-term low. All right, so we are trading below this low here. This is a short-term low, and we are also trading below this low here. This is a swing low. So that's a daily swing low. You have one candle which is high, lower candle, and then a higher candle that is a swing low right there. All right, so we have a daily low there. So let's get rid of this. It's not really necessary. We're trading below a daily low. We're just going to be obviously fund level, sales liquidity resting at. And we're returned back down into a bullish block. That's this down candle prior to the expansion higher. So that is a discount rate. Now that does not necessarily mean that we're expecting a reversal from there. All right. So it's important to take note. So when you have a daily sentiment, you don't just go into the marketplace ignoring. If your daily sentiment is bearish, you don't go into the marketplace ignoring discount rate, because a lot of times what will happen is the market will see a measure of distribution at discount. That's why we call them a discount rate. Even though we're expecting the market to ultimately run for sell side liquidity, that does not mean the market is just going to run for sell side liquidity all at once. All right, it's going to do so in cycles. Like you can see here for this week, the low actually came in at this volume imbalance because that's a discount. Right, the market trades down into that volume balance, which is a discount, and then you see a measure of distribution. For this week, it is the sell side liquidity down here and this bullish order block. How can you identify what discount rate to see a measure of distribution from? Utilizing time of the week, and this is where you get your TGIF setups. You can see here, we run down into this on Thursday and the distribution comes on Friday, right? After a huge range expansion on the downside. Same thing with this week. Once the delivery cycle starts, we have 1, 2, 3 consecutive days of large range in the direction of order flow. So we can expect on Friday a measure of distribution. So that already sets the tone or bias that we could see some kind of delivery higher for Friday. So going into the intraday template or the intraday profile or time frame, your classic London protraction. First of all, we need to do is we need to identify our central bank deals range. You can see here starts the CBDR and here ends the central bank deals range here. And then you can see our Asian range ends right here. All right, so look at the range from the central bank to this range. Consolidation, Asian range, also consolidation. We like this for a flout. So what we're gonna do here is we're gonna take the lowest candlestick body to the highest candlestick body there. Okay. Now remember, for the flout, we're not using the range projection for our standard deviations. Okay, what we want to do is we want to divide the range by half and then project our standard deviations from the equilibrium to the extremes of the range. Okay, so this is the middle point of our flout, which is the blending of both the central bank deals range and also the Asian range, and then we can then use our projection for, if we're anticipating TGIF, we're looking for bullishness in price, right? So from the equilibrium to the lowest close of this candle, and we have one standard deviation down here. And then we have a half standard deviation here. Okay. Now, right around the half standard deviation, you can see that higher time frame discount rate, which is that daily bull trend block. Okay, and this line here is that daily sell-side liquidity. So we are below a daily sell-side liquidity inside the discount, which is a daily bull trend block. You have your classic. This is our London session. Let me actually switch this over. Get rid of this. So London session starts here, and if we go and look at this on the sell profile, okay, we're just gonna flip this for bullishness. On the sell profile, you get your classic Asian consolidation, which is what you have here, and then going into London session, there's a sudden movement per 9 time for premium plus a standard deviation. So going into London session, all right, you can see that sudden run lower. What do you think is going on here? So if I switch this all the way to the left, okay, and this is Asia. So all of this is pre-London session. So pre-London session, we're seeing the market do this, and then all of a sudden during London session, the market starts to do this. What do you think is going on in the mind of retail as the market starts to do this kind of price over? We are bearish, correct? That's what everyone's thinking, because we can see very clearly the market is running lower. So we are definitely bearish. But the market was really just running down into a standard deviation plus a high time frame discount. Now, I'm not saying necessarily you can go in and look for longs down here. Okay, some of you guys don't have the confidence or the experience to pull that off. So what you can wait for is, you can wait for displacement in price, okay? And what we're looking for is we're looking for a shift in structure, right? That's why I mentioned here. And I mentioned that some of you guys might be actually scared to go and short this. Now, personally, that's the best time you want to be taking your execution. While the market is screaming bullish, or in this example, while the market is screaming bearish, that's when you want to go. As soon as it touches your high time frame discount coupled with your standard deviation, that's when you want to go in and put your execution using a 30% stop loss. But again, some of you guys might really be scared to do so. So what you can do is you can wait for the market to make a short-term high, and you can buy the retracement of that short-term high. So while the market make a low here, our short-term high is up here, and the market runs higher and then slams down lower, and our short-term high is now here. So we see displacement in price, and where's our discount? Bullish order block. All right, so we can buy the bullish order block, aiming for equalize up here and some kind of premium, which we're going to use our standard deviations to identify. Okay, so let's assume we bought at the bullish block. If we're buying bullish block, remember your stop goes with the order block there, right? So your stop is below the order block. You're aiming for some liquidity above that high. The market trades down, triggers your entry. But now look at the delivery of price. It trades this deeper into your bullish block. You don't like this for the validity of a trade. Okay, so as soon as the market trades higher, is this a good trade? It really is not. But let's assume that you don't do anything. Just leave a trade like this. The market trades down and it starts to trade higher and it looks good, and all of a sudden it just slams down again. Would you look at this as a breaking structure? It's not. Now let's see if this run below the short-term low, and it's doing this again still inside of London session. Can we confirm that with lower prices on dollar? No, as we're running lower on USD/CHF, dollar is failing to run lower. So that means that this run lower is not supported by the institutions, aka it is artificial pricing to grab liquidity, and we can trust this low here. And it's also coming in at a higher time frame discount coupled with our standard deviation. So again, we don't necessarily need to rush and look for executions. We can wait for displacement and then buy any retracement we can see in price. So you can see during London session, the market makes the low, and then this is the start of New York session here. And just by simply waiting, you can see you also have the same delivery cycle for New York. The market makes the initial protraction lower, which convinces everyone that we're now bearish in the marketplace. And all the market was trading down into was this old fair value gap here. So we have an old fair value gap inside our bullish order block down candle. So we can buy the bullish order block because that's a discount. You can remember what I mentioned before. New York session will see a retracement back into the range from London session and continue the delivery cycle or the delivery profile. New York session sees a retracement back into London session, and you can go back in again and look for executions or setups with your stop below the order block as in previous example. And with New York session, you can use a tighter stop. Now with London session, I opted not to use a wider stop because I just wanted to be realistic with the outcomes and show what you would do if you take a loss. And you'll be aiming for this short-term high and some kind of, again, if we use our flow here, find the and then extend this out. All right, so where do we have buy sell liquidity? We have one here, okay. We have a short-term high here. All right, this is the last major high prior to run lower. So if price is gonna seek premium, we can aim for this. We don't concern ourselves with anything outside of that. Okay, this is something easy to aim for. So we can do 3 standard deviations, all right, as our objective, because that is relatively where the high is. And if we want it to be more, we have also premium here, which is a fair value gap. If we wanted to allow some runners, we can do 4 standard deviations in price. All right, so we can do 3 standard deviations, 4 standard deviations as an upside objective. And let's see where the market reaches up into. All right, so you can see the market reaches up into that 30 standard deviation, which is why I say you want to take a bulk of the profit and consolidate into the rest of the day, right? What time window does it consolidate in? during London close, can you see the delivery profile? Classic, price delivery. And then go into New York close, it just consolidates going into end of day. Alright, so there's your classic delivery cycle where London sets low of the day, New York continues the delivery, and then during London close is where we start to see profit taken by the institutions. Okay, so that is for your classic protraction and profile for London session, or your normal protraction and profile for London session. Now let's do one for delayed protraction. All right, so we're just gonna run through one. This is one delayed protraction, but I want to use a better example. So in future lessons, I can just pull up any chart. You guys already know what I'm looking at. Now you can see that here, this is a delivery profile for Tuesday, 20th of January, and the price action we just saw was that from Friday, 2 weeks ago. You can see that we make a short-term low during New York session the previous day, and we don't see a ton of expansion, okay, as we make the short-term low into our higher time frame objective. What's our higher time frame objective? Let's reset all of this. All right, so at this point here in price, we have an old low. All right, or you think retail is looking at this as we trade up into the old low? That's resistance. All right, so retail considers this resistance, especially as we trade up there and see a little bit of consolidation on Monday. So we know going to Tuesday, we're gonna slam through that because retail are shorting this, thinking that's a top. Especially if they're looking at this and they're thinking that's a double top, they're shorting that. Okay, we already know that there is a premium, because if you did your range measurement from high to low, we're not at premium, so it does not make sense for the market to sell off from here because it is not at the premium. So it needs to go up into level of premium to look for lower delivery, and our premium starts above this candle. So what period do we have above this candle? This fair value gap. So we know at bare minimum the market has to at least trade up into this fair value gap. Okay, that's what we're looking for. So that, because that's the PDR we can identify at premium. Everything else inside this range, they're all at discount. All right, so going to intraday profile, you can see that we don't see a ton of expansion the previous day, and the market trades a little bit higher right now, buys up and then consolidates. So we know the market is going up into the fair value gap that starts all of the expansion lower. Now, if you looked at this, you can see this is a bearish order block, and then this is a propulsion block, because that's where you start to see speed of displacement or delivery. So we can aim for this propulsion candle as a short-term upside objective, aka as a confluence of a primary. Now, going into Asia, you can see we start to actually trend. Okay, it's not the tight consolidation which you come to expect in terms of price delivery. The market is actually trending. Okay, so as we open up, we see the market make higher highs, higher lows, higher highs, higher lows, higher highs. You have a run and sell stop, and you're seeing very clear delivery during Asia. Now, remember what I mentioned before? London would be a lot of times a retracement back into the range of Asia, but then a continuation price delivery. All right, so what you can see here is this is the start of London session right here. You still get a classic run lower, okay? But it's not a classic one whereby the market is running out of a consolidation. It's simply just a retracement back into a range. And what's the range? The range is the range from the central bank to this range going into the start of London session, okay? So if you did your Fibonacci like this, you can see the market is just simply returning back down into the range. Now, unlike the classic profile where London actually sets the low of the day, here London does not set the low of the day. The low of the day will be set usually during Asian session or during the dead period before Asia, which is what you get here, okay? And the market trades down into this bullish block and sees expansion higher, but does not get up into that propulsion block. Now, what you want to use here is, again, we have a small little consolidation for the central bank to this range. So we're going to actually we're gonna look for the highest close. All right, highest up close, lowest down close for Asia, and then we're gonna extend that out, and you can see right around 3.5. Do we get up to 4? We don't get up to 4. So right around 3.5, which is where we have that fair value gap. That's where we set the opposing end of the daily range. Now again, like I mentioned, in this example, you're not looking for your classic retraction. So you're not looking for any standard deviation lower for this buy template for the market trade down into to see expansion. You're only using your standard deviation for the opposing end of the daily range, right? And that also has to coincide with time of day. Now in this profile, you actually get London close also still making the high of the day or the opposing end of the daily range. But again, a lot of times this does not actually happen. Okay, a lot of times what you get is that New York session makes the opposing end of the daily range instead, and London close does kind of like a reversal price delivery. And in this example, it's not every single time, but a lot of time that's the profile that actually happens. So I would want you to go on the charts and do some kind of like experimentation with these profiles, so you can kind of like gain experience with the recurring themes, because it is all just a recurring price delivery profile, right? So you can gain some kind of like experience with the recurring things, and you start to see very clearly how the market delivers with these kind of profiles. Hopefully this has been insightful, and I will talk to you in the next lesson. Trade safe.